If you clicked on this video wanting to find out whether or not SOFI is a potential multi-bagger in the years to come, you have definitely come to the right place. But because I scripted this video a while back, I think it's a little disingenuous if I don't actually acknowledge certain developments in the macro recently that added on another layer of risk factors to this investment. The fears of a recession are definitely not unfounded, and if we do enter a recession, financial stocks tend to perform poorly. This means that the stock price can stay depressed for a longer period of time than we had hoped for. However, I do have reason to believe that SOFI's business is resilient enough to overcome a recession, and in fact, if you ask me, I honestly feel more comfortable investing in a company after it has shown that it is able to survive a recession. And so with that, let's dive in. This SOFI Technology aims to be a one-stop shop for financial services. Now, their business has three key segments: lending, financial services, and technology, as their name suggests, right? So I've previously used this framework to break down how I actually analyze Google as a company, and we'll be doing the same thing for SOFI at a deeper level. Today, we'll provide a more qualitative analysis on why SOFI can potentially be a multi-bagger in the years to come. And in the next video, we're going to talk about certain tangible, measurable results that we can use to track SOFI's progress towards their goal. And you see, my investment philosophy is this: I believe that in investing, one of the most dangerous words is potential. People get excited about potential, but unfulfilled potential kills investments. You see, anyone can tell you a story, and every single growth stock has their own growth story. However, not every company is able to bring that story to fruition and to realize that growth potential. That's why although we invest because we believe in the story, we do need to remain objective and to have real markers and indications that are tangible to allow us to see that the company is steadily progressing towards their goal and to actually see the growth story playing out for all investors. Now, SOFI started as a lending company back in 2011, primarily focusing on student loans. In fact, they grew to become the largest provider of student loan refinancing in the US. However, I think the previous management wasn't very good. They had tons of allegations thrown against them before the CEO finally stepped down and the current CEO, Anthony Noto, took reins. Now, I believe that a company is only as good as the vision that is set forth by the CEO and the CEO's ability to drive people to achieve that vision. So I think in Anthony Noto, I'm quite confident that, we actually have a very good CEO at the helm. In fact, if you ask me, I think he's probably the top 3 CEO in US at the moment in terms of execution and ability to drive people forward to achieve the goal. And so he's basically one of the biggest reasons why I have such a high conviction in SOFI, but we'll talk about him later because first we have to understand how he's running the company. As I mentioned earlier, SOFI was primarily a lending business, and much of this lending actually come in the form of student loans. In fact, back in 2019, about 99% of their revenue came from loans, and out of which about 60% actually came from student loans, which means a large portion of their annual revenue came for student loans. So during the pandemic, right, when the student loans repayment were paused, basically what happened was that SOFI's revenue was wiped out, or at least a large portion of their revenue was wiped out. And the impressive thing is that SOFI not only did not stagnate, they continued to put up impressive growth numbers, which is basically a testament to Anthony Noto and his team. Additionally, they actually received the bank charter back in January of 2022, and then because of that, right, they actually saw increased profitability because it lowers the cost for them it takes to fund the loans. And so sometime in 2023, SOFI actually acquired this company called Wyndham Capital as they look to expand their mortgage offering. So the second segment of their business, which is also one of the most important segment of their business, is the financial services component. SOFI actually takes a very broad understanding of financial services. Basically, it's made up of many different services and many different components. So some of the key ones are SOFI Money, which is their savings account. You have SOFI Invest, which is their investing platform. SOFI Credit Cards, this one's self-explanatory, right? Credit cards. Then they also have SOFI Protect, which is their insurance arm. And SOFI Relay. So SOFI Relay, right, how I think about it is a little bit like SG Findex for those of you in Singapore, where you combine all your information into one platform. You're able to look at everything and manage everything through that one platform, even though they're from different banks and things like that. They also have this thing called SOFI at Work. This one is basically where SOFI works with employers to provide employee benefits. But basically, if I were to sum everything up, right, it's basically people who are using their SOFI app, using their products through the SOFI app and applying for their credit card. So all these features are basically accessible through their app, and that's how we want to think about financial services when it comes to SOFI moving forward. So basically, the idea, right, is that you're able to settle all of your financial needs all on their app and all through their platform, right? You either get onboarded into the SOFI system either through loans or through using one of their products, and then you tend to stay on because you're already comfortable with the service that they provide. And you go into this thing called the financial services productivity loop, which is actually a key to understanding SOFI's business. Because the idea is that you come on board either as a student taking on a student loan or taking on your first mortgage loan for buying a house and things like that. And as you build up your credit history and as you build up your profile within SOFI's ecosystem, they are able to offer you loans at a better rate. And because everything is already with SOFI, right, people tend not to switch banks so frequently. And so for example, as a student, you take a student loan, you repay your student loan, you build build your credit together with SOFI, right? And then when you get your job, you basically credit your salary there and things like that. And then when you get your house, you might start to get your mortgage loan from them. You may settle your insurance through them and things like that. And you basically already start to build up this profile with SOFI. And so over time, even as you need a loan in future for your business or for buying a second or third house and things like that, they're able to give you a more preferential rate, I think, because of the profile you have already built up with them. And I think the thing is, most people generally tend to only have 1 to 2 bank accounts and they stick to it. And I guess that is the premise for SOFI. You're attracting the younger, more affluent crowd onto the platform. And basically, as they grow their net worth, right, they will grow in the use of SOFI services and in terms of the number of products that SOFI is able to cross-sell to them. So basically, you have to understand this whole premise of the great wealth transfer, which we will talk about later on. In their earnings, right, SOFI actually likes to show this chart, which shows the whole pipeline of how their lending and financial services cross-sell into each other, how customers actually filter through the various products that they have on offer. And this is very important in understanding how profitable SOFI can be, because they actually tell us, right, that a customer that is onboarded through their lending product has a lifetime value of about $1,000 per customer. However, if you come in through the SOFI app, then your LTV doubles to about $2,000, and we actually see that this will increase with time as they become more and more profitable. So what makes the financial services platform a core to the business, right, is this understanding that as long as people come in through the financial services platform, build up your profile with SOFI, that you can eventually become a very profitable customer of SOFI in the long run, as long as you maintain your banking with them. This financial services component of their business is actually their fastest growing component. It's actually growing at about 70 to 80% a year. That's right, you're hearing correct. 70 and 80, 70 to 80% a year. And I think what makes it amazing, right, is that it's not just the revenues that are growing. This is actually a very profitable segment of their business. Just to put it into context, right, last year, this segment of the business was losing about $4 million in this latest quarter. However, this year they're making about $55 million. So the reason why that is, right, is because I believe they are a digital bank. They definitely have much lesser overhead. They don't have so many brick and mortar outlets that they have to manage compared to the traditional banks. So basically, they are able to operate more efficiently. But even after saying all these things, that is not the real source. What I have just described is a very fast growing bank. It is a good business, it has solid management, but it is a very fast growing bank. And what makes SOFI potentially great is the technology that it houses. This brings me to the third segment of SOFI's revenues, which is their tech platform. Now, basically, SOFI's business, right, has been a B2C kind of business, right? You are basically serving the consumer as a bank. But now with this tech platform, they basically include a B2B component. You see, SOFI actually paid $1.2 billion to acquire this company called Galileo, and another $1.1 billion to acquire a second company called Technisys. And these two companies work together to provide the back-end infrastructure to operate a bank. Basically, on a very high level, right, Galileo's API allow people to actually set up their bank account digitally and for SOFI to issue them debit cards, right? And what Technisys does, Technisys is basically a core banking system. And what I mean, just a very quick understanding of it, is that it basically works on the back end to help ensure, basically, whenever you make a transaction, right, when you tap your card, this transaction goes through, money needs to be deducted from your account and needs to be reflected that this transaction has taken place in that account, and Technisys basically allows you to do that. So Technisys, together with Galileo, allows SOFI to build the back-end infrastructure of a bank. And I think, to me, this tech component is very interesting, because if you think about it, right, what SOFI is trying to do is that because they actually already need all this infrastructure, they're buying these companies so that they can actually have their cost savings as they build up their own back-end, at the same time licensing this out, creating an extra source of revenue for their company. So I believe with all B2B segments, right, the sales cycles are pretty long, implementation will take a while, but competitors are actually already using their platform, right? Companies like Robinhood are already on Galileo. They're actually in talks with a big financial institution. They didn't really specify who that is. There are certain rumors going around. It could be Citigroup and things like that, but I'm not exactly very sure. And I tend not to speculate on this, because I think when it comes to B2B sales, the sales cycles are quite long. Implementation may take quite a while. If one client does not onboard when you expected them to onboard, right, that will already basically affect the growth projections already. So growth is going to be a little bit lumpy at the moment until they start to ramp this up. But I believe it's just like Amazon when they first started, right? When they first started AWS, they built it for themselves and then eventually licensing it out to other people. Oh my goodness, my pronunciation today. So I guess it's a bit like Amazon, right? Amazon basically was so-called just a bookstore, and then after that they built AWS for themselves and basically licensing out AWS after they actually made it successful. So basically, I think SOFI is going into the same business model, which I don't think is a surprise, because Anthony Noto, in his younger years, was the analyst that spotted Amazon's growth back in the 1990s. And so because it is a very vertically integrated system, which means that they provide the banking service on the front end, and on the back end, they own the technology that actually runs the banking service. They actually enjoy a cost savings of about 70 to $80 million every year. And basically all these savings, right, will end up going down to their bottom line, which gives them a higher net income compared to other banks lah. So actually, while filming this, right, actually news just came in that a bank called Vero Bank left Galileo's platform and basically went to sign a contract with Marqeta, their competitor, right? So I actually heard this from Tanner from Future Investing, who actually showed Anthony Noto, yes, the CEO of SOFI, replying him personally about this migration lah. So he basically told Tanner that this migration was done before their acquisition of Galileo. So by in 2020, back when they are buying Galileo, right, they were already aware that Vero Bank was going to move off, and this migration actually took a couple of years to happen lah. So basically now they have fully moved off Galileo's platform in 2023, and they are now onto Marqeta's platform. Now, the reason why they move off Galileo platform is very important, because at that point in time, what happened is that they required certain back-end support from another company which Galileo didn't provide. And this is the most important part of this conversation, okay? Because right now, after acquiring Technisys, SOFI does provide that kind of additional back-end support that this company needed. And seeing how this was a requirement for acquiring some of their fintech license, it stands to reason that SOFI is basically now well positioned to start taking market share. So basically what this means is that, Galileo as a standalone company did not have certain back-end support systems that certain companies need when they actually run a fintech. However, now with Galileo and Technisys together, SOFI actually does provide that offering already. So because of that, I think, like I said, it stands to reason that SOFI is well positioned to take market share, and we need to see this execution by growing Galileo accounts and revenue going forward. So I'll link to Tanner's video over here and you can take a look at it, because I think he goes much more into detail about this. But I think it's just a good idea for us to understand how their platform is working, how it's actually changing and adapting to suit the needs of fintechs and digital banks today. I think what makes SOFI interesting for me, right, is their total addressable market. When you understand their total addressable market, it is really huge because of the way they run their business, right? They actually have arms into so many different business verticals. So basically, if you consider their total addressable market, there's the consumer-facing side, which is basically their banking, and then there's also the tech-facing side, right, the back end. So if you're talking about just digital banking, right, on a global scale, it's currently a $9 trillion market lah, with a CAGR of about 11.5% from now to 2031, making it easily over $20 trillion by then. Now, when it comes to net interest income, right, the interest that banks make globally, it's at a $8.5 trillion market cap, growing a bit slower, but because it's already such a big market already, it doesn't need to grow very fast, right? It's going to grow 5% CAGR from now until 2029. And then the interesting one, which is basically credit cards, right? Anthony Noto actually said in a recent earnings call, right, that he actually sees that the credit card business of SOFI can be bigger than their entire business currently, which means that he actually sees the potential for the credit card to generate over $2 billion in revenue. But like I said, this word potential is always very dangerous. We need to see execution in that. But he had good reason to say so, because the credit card market will grow from 14 trillion to 17 trillion over the next 5 years. However, I do think with their current credit card offering, right, I don't think it is as yet a compelling reason for people to switch over from their current credit card into SOFI's credit card. However, if this is just the testing bed, this is just their starting point, then I'm okay with that. However, also, I think one thing to consider is that because their targets, right, is really new, affluent, young working adults lah. So basically, this is a good card for someone who maybe doesn't have a card or who wants a secondary card to complement what they have at the moment. But I'm interested to see how this segment of the business grows as they balance the rewards that they give out to attract people as well as profitability of this. So if you look at the depositors, right, basically for SOFI, their US customer deposits was at 12 billion last year, and that nearly doubled in the space of this last year to 23 billion this year. So what we can see is that they are growing very fast, but they still have a lot of room to grow. And all of this is just basically consider their consumer-facing business without taking into account their back-end tech. And if you really add that in, then their total addressable market is huge. And I like to invest in companies with big total addressable markets. After understanding their business, we need to understand the captain that is driving the ship. After Anthony Noto graduated from college, right, he basically worked at Goldman Sachs, and he was basically specialized in analyzing the internet industry. He spotted opportunities like Amazon, which I was mentioning earlier, eBay, Yahoo. But bear in mind, right, all this happened in the 1990s, I think around 1999. So when the 2000 crash came, he, along with many others, made bad calls in the market and had a lot of nicknames, right? I think one of his nicknames, apparently, from what I see, is called Anthony Don't Know, which was quite funny. He stuck around even after the crash, and he continued to expand his understanding of the markets. And eventually, he made managing director in 2003, and in 2004, he was a Goldman Sachs partner. So why did that happen, right? It's because I think his returns from 2001 after the dot-com crash to 2004 was about, he had an annualized return of about 23 or 24%, so which is actually quite impressive lah. So when he finally left Goldman Sachs in 2007, he became the CFO of the NFL. And then after that stint, he actually came back for a while to Goldman Sachs. He worked on deals like Twitter's IPO, Dropbox and Spotify and things like that. So after his second spell at Goldman Sachs, right, Anthony Noto basically became the CFO of Twitter from 2014 to 2017. Now, halfway during that stint, he actually was moved to the position of COO, which is Chief Operating Officer, in 2016. So in 2017, he fully handed over the CFO role and became the CEO of Twitter until 2018, when he finally took over the role of SOFI Technologies. So one of the incidents that actually made Anthony Noto really stand out to me, right, was during COVID. I heard that, in the US, they actually paused the student loans repayment. So knowing that, I actually thought, SOFI will be a dead company, and I didn't basically pay attention to them during that time. After some time, I realized, hey, this company was still around. So when I take a look at the financials, right, I realized although the student loans were paused, they managed to pivot into other businesses, and they actually kept up their impressive growth numbers. So this was when I started to pay attention to Anthony Noto, and I realized that from the time he actually took over as CEO of SOFI until now, he actually grew revenue by 7.5 times. So if you compare SOFI's revenue, right, from 2019 right to 2023, they actually have a CAGR of about 46%, which is quite impressive considering all the nonsense that has happened over the last couple of years, right? And at the point in time when he took over, lending was a large portion of their business. But when you look at it in 2023 and even moving into this year, you can see lending has become a smaller and smaller part of their business, not because they actually cut down lending, but because the other parts of the business has been growing so quickly. So by the end of 2024, he has actually finally fully pivoted the business where 50% of the revenues come from lending and 50% come from financial services and tech. And so under Anthony Noto's leadership, I don't think you can call SOFI just a bank anymore, because 50% of their revenue is from lending, but the other 50% is from financial services and tech. And since we're on the topic of Anthony Noto and management, I just want to talk about this. This is one of the reasons why I really believe in SOFI achieving their goals. Because one of the things I look at when I look at management, right, is the compensation structure, whether or not it is aligned with shareholders. So when we talk about the compensation of management, right, actually what I'm talking about is basically this arrangement that Anthony Noto and his management have with the company, that basically they need to get SOFI stock up to a certain price point by a certain date for them to receive a certain amount of shares as their compensation. So it's a bit like stock-based compensation, right? So basically, the idea is that they need SOFI stock to reach certain levels, and these levels are actually already predefined during the contract when he was signing the contract. So these levels are that SOFI needs to be around $25, $35 or $45 by 2026 for them to receive a certain amount of compensation. So basically, he had a certain amount of shares promised to him. He'll receive 1/3 of the shares if SOFI hits $25, another 1/3 at $35, and the last 1/3 only when SOFI hits $45. So because of that, I do believe that management goals are very aligned with shareholders, and that's one thing that I really like about the management and the whole structure of their compensation. So moving forward, right, I do think that there are some financial services verticals that don't even exist in-house at the moment, which is what makes me so excited about the company, because they actually give a very high projection of their income in 2026, and they told us that they're able to hit this income number just by operating their business, which we will explore in the next video. But basically, because their consumer-facing segment is still a bank, right, they have so many other verticals they have yet to build up. Things like the small, medium businesses side of banking, investment banking, asset management, even their own insurance arm, because their insurance currently they're using a third party. So Anthony Noto has actually told us that, hey, you know what, I'm not just looking to drive growth in this next 3 to 5 years. I want 20% CAGR for decades to come, not just 3 to 5 years. And for that to happen, right, the team really has to innovate at a very fast pace. They need to keep building new S-curves for the company so that the growth can really be seen in the revenue. So I think for now, right, if you consider the next S-curves that they are investing aggressively in, that's really the credit card side of the business and probably the brokerage side, the SOFI Invest side. So hopefully all these revenues that is being generated from the financial services will start to show up in their income statement soon. And I think apart from that, they also want to drive up the growth in their tech platform. So apart from financial services, right, one of the key things I want to pay attention to is SOFI's tech platform. Now, you see, in this past quarter, one of the things that actually got me a little bit concerned about this platform is their lowered guidance moving forward for the rest of the year. So basically, the tech platform was previously guided to grow at about 20%. Now they lowered their guidance, saying that it'll grow at mid to high teens percentage. So as an investor, naturally, this was something I'm concerned about. So I did a little bit of digging. Basically, when you listen to what management has said in the past, they've always told us that, you know what, the sales of this tech tech platform is a long and complex process. And so what that means, right, is that, today maybe the client say, okay, I'm going to go with your platform, but from the time they say okay to the time, the whole tech platform is basically implemented and SOFI gets paid, that may be quite a bit of time. So some delay in one or two clients may cause a big hit in terms of their revenue. Why I'm not concerned, right, is that because in the long run, the projection of over 20% growth is still maintained by the company. So I basically have no concern over there. I just see this as a hiccup. And when you look at the data, this kind of, justifies whatever management has said, because the growth of Galileo accounts in this past quarter, right, was actually quite healthy. Galileo accounts, just the number of accounts was up by 23%. The only problem is the revenue in this segment is only up by 9%. So like I said, this has to do with the sales cycles. Maybe, the accounts are being onboarded into Galileo, but they're not being paid yet. So I do think this is basically down to the way that they implement Galileo. And as an investor, naturally, right, if you ask me, I do hope they make a little bit more data available on how they implement Galileo, the pipeline that they have, just like any other SaaS companies. It's important for them to look at expanding the team or making the team a little bit more efficient in the way that they implement Galileo and Technisys and things like that for other fintechs. Because if you ask me, basically, right, if they do want to really grow their tech platform seriously, I don't think long and complex sales cycles can be an excuse that we accept in the long term for a slow implementation process. You can see so many SaaS companies out there also have long and complex sales cycles, but they actually find ways to actually shorten that process every single time. And the faster that they can implement the process, the faster they can generate revenue. Now, earlier on in the video, I actually spoke about how some developments in macroeconomics, right, basically pose a risk to SOFI, and why despite all this risk, I still feel very comfortable holding on to it. And it has to do with what management said at the end of last year. Now, in Q4 of 2023, right, when we listen to management's projections for 2024, how they expect the business to grow, they say that they basically make two assumptions about the economy. The first one is that there will be a contraction in GDP in 2024. However, when we look at GDP now, has GDP slowed down? Yes, even if we look at the GDP now by the Atlanta Fed, we actually see that GDP has slowed down to about 2%, but it's not a contracting GDP. It's just a slower than expected growth. And then the second thing that they actually assume is that unemployment will be higher than 5%. And when we look at the recent data, unemployment is only at 4.3%, so well within SOFI's guidance. So why I'm confident in holding SOFI, right, is basically because these recessionary assumptions are already built into management's projections. So what does that mean for me as an investor? It means that if the US enters into a recession, then I know what kind of business projections to expect from SOFI. But if they don't enter into a recession, then everything else is a bonus, which actually means that we can expect management and SOFI to basically beat their expectations moving forward, right? So if we just take a look at the most recent quarter, in terms of their members, they actually grew members by 643,000, which is 41% year-over-year growth. The number of products that these members are using increased by 946,000, which is a 36% year-on-year growth, means people are using SOFI more and more, right? The Galileo accounts basically is now at 158 million, which is a 23% year-over-year growth. So to me, right, this is a company that is still growing at a very healthy rate. So if we take a look at Q2 of 2024, we can actually see that it was a beat across the board. Adjusted net revenue came in at 597 million compared to 565 million that was projected. Adjusted EBITDA came in at 138 million compared to the 125 million projected. And get net income came in at 17 million compared to about the 5 to 10 million that was projected. So when we take a deeper dive into revenue, we actually realize that lending only makes up 55% of overall revenue right now, and their tech and financial services platform is basically catching up, making about 45% of overall revenue, and they expect this number to basically trend to a 50-50 split by the end of the year. Now, another interesting thing, right, is they actually tell us that 30% of all direct deposit members, right, end up taking on a second product within 30 days of onboarding into the SOFI platform, which basically adds on to their financial services loop that we talked about earlier in the video. So moving forward, right, in Q3, they basically expect revenue to come in at about 625 to 645 million, adjusted EBITDA to come in at between 160 to 165 million, net income to come in at about 40 to 45 million, which means an EPS of about 4 cents. Now, if you combine everything together, right, it seems like they already have an EPS of about 7 cents. And if you consider at the start of the year, analysts basically projected that their whole year EPS is 8 cents, right? They'll definitely smash initial analyst projections. However, if I'm not wrong, right now, basically analysts is expecting them to come in with a full year EPS of about 10 cents. So if by Q3, they beat their EPS expectations, maybe come in with 5 cents, adding on to whatever they already have, being at 8 cents EPS at Q3, I think 10 cents EPS for the whole year is still too little. Now, at this point, there are basically two things I want to drive your attention to. The first thing being lending revenue. Now, in the past, they actually guided that lending revenue is expected to be about 92 to 95% of 2023 levels. However, now they say it will be at least 95% of 2023 levels, and I believe this is due to their expectation of rate cuts coming in the horizon. And this second point really gets me excited because their financial services is their fastest growing business business segment. Now, in the past, they actually guided for minimum 75% growth. Actually, in this last quarter, they actually told us minimum 80% growth. So why is it so exciting for me, right? Because to me, this financial services platform, when you look at the profitability, last year, this segment was actually negative 4 million in contribution profit. However, this year, it's positive 55 million in contributing profit. So they actually made up 59 million in terms of profit. This is a key aspect of their business because I believe that this business segment has fixed costs. Now, they may incur a lot of costs, one-time costs at the start when building out their offering, right? So now, like when they're building out their credit card offering, they may incur some costs there. If you think about it with me, right, it's like once they build out their app, every new member that they onboarded into the platform, they do not incur any new cost of having to like redevelop the app a second time. And the only cost they incur is possibly incremental improvements along the way. Okay, very quickly jumping in here, right? Because I realized after filming everything, I forgot to talk about this. And I think this is a very important point on basically showing the competency of SOFI's management. Basically, why I want to cover this slide, right? Because one of the reasons that people are generally afraid of investing in financial companies moving into a recession is because people tend not to pay back their loans, and then these companies have to eat all the losses. So, it's like that saying, if you owe the bank $1 million, that is your problem. However, if everybody owes the bank $1 million, it is the bank's problem. And that is basically what people are afraid of. Too many people owing SOFI money, not paying back the money, they'll make larger losses than expected. So SOFI, knowing that, they basically gave this graph and said that, hey guys, relax. You see, basically during their projections, they actually projected that generally when we lend out money to people, 7 to 8% of these people will not pay us back. Now, they already have that in mind when they make their projections, when they actually plan their business. So in this graph, right, what they're trying to show you is that the last time that we lent a group of people money and 8% of them did not pay us back was back in 2017. So in 2017, you can actually see 7.85% of the people did not manage to pay back their loan. So basically, they have to write off all these loans. So if you just look at the different colored lines at the bottom, you can see that everything at the moment is going below trend. What that means is that there's a very high likelihood that all these people that they have lent money to in 2022, 2023, so on and so forth, they're actually going to manage to pay back the loan, and they're actually going to suffer lesser loss on these loans than they expected. One of the things I want to point out is this dotted line in the middle, this grey color dotted line. Now, this grey dotted line represents the 40% mark in terms of the repayment of a loan, which means that everybody at the point in time only left 40% of the loans to repay. Now, why this is important, right, is that you can actually notice that after this 40% mark, once the graph actually passes this dotted line, the curve actually tends to become a lot more gentle. Why? It's because usually when people default on their loans, that happens during the initial repayment phase. And then once you have 40% of the principal left, generally most people manage to pay off their loans. So you can actually see the decline, right? During the first 60%, about 6.07% of the people actually defaulted on their loans. But between the 40% mark to the end of the loan cycle, actually only an additional about 1.8% of the people. So what SOFI is basically telling people who are afraid is that, look, we are already under trend compared to 2017 when we first hit 8%. So chances are we will not hit 8%. And plus, once we pass this 40% mark, the curve will start to smoothen out and start to become less steep. So we can actually expect even lesser life of loan losses than 8%, which is basically what they have been projecting all along. So that's why I say, in terms of SOFI's management, in terms of their underwriting processes, they're definitely very stringent, and that is one of the reasons why I feel so confident in the management of SOFI. So if they continue this, I can see how this helps them achieve their 2026 target of 55 to 80 cents EPS. And of course, management can always be blowing smoke up our asses and things like that. So to find out how I keep management accountable and what I look out for, you really need to pay attention to this second video that I'm going to link over here, and I'll see you in the next one.